Guy, fantastic to have you back on ET Now. Thank you for joining us. Last time when we had you on the show, it was right in the middle of pandemic, but now the world has changed, markets have changed, and everything around us is normal.
Oh, well, it's great to be on your show. Thank you for having me back. Thank you for saying those kind words about me. The world is in a different place. I'm not sure that we're in normal. I don't think we ever were in normal, but we're just out of lockdown. And actually, most of us are out of lockdown, but as we read, China is not out of lockdown. So the world is going through some very, very big adjustments, it seems to me, and is anything but normal.
Guy, this year has been an extraordinary year of peaks and troughs and twists and turns. We started the year on a high note with the assumption that interest rates will never go higher. We're ending the year with an assumption that interest rates have peaked out and they will start coming down next year. What is the reality? What we saw 3 months ago or what we will see after 3 months?
Isn't it fascinating? And we know that at the end of the 1970s, interest rates were as high, I believe, if I'm not mistaken, as 20%. But we also live in a world in which the vast majority of market participants look back maybe 1 year or 2 years and they think that that's the normal and they cannot perceive anything else to come up in the future. And so when interest rates rose from their very low levels to where they are now, that surprised many people. But I think that the way we want to live is to be aware that the markets can do the most unusual and extraordinary things, and expect the best. So the best would be that interest rates do start coming down, but prepare for the worst and be aware that there are states of the world that are unforeseeable today that could result in interest rates being double where they are right now. And our job, every single one of us, either as managers of our individual finances or as managers of funds, need to know that we can find a way through even though in those extreme circumstances. And if you ask me to actually, so the answer is I don't know where they will go. I'm saying that we should not, even though we would like for them to go down, they may go way, way higher before they go down. And if you ask me what my expectation is, and this is not based on any ability to see into the future, but I think that my working hypothesis is almost always that they will stay more or less where they are. I actually think, having said that we cannot rule out the interest rates don't go higher, there is an understanding amongst central banks that if they force that issue too hard, they will actually do damage to the economy. But will interest rates come down as quickly as we would like? Quite possibly not.
Guy, if I look at your top 3 holdings, there is in Berkshire Hathaway, there is in Chinese bank, and there is an Indian energy exchange. Is this by design that you're looking at investing in the 3 large economies, or this is more like a company stock specific approach?
So in the case it's stock specific, but my allocation to India and China was far lower at original cost of the investment. But what happened in both India and China with those 2 investments is that they appreciated by so much that they now have similar magnitude in my portfolio to Berkshire Hathaway, which is kind of a far more predictable and understandable investment. As we went into global instability, if you like, I think that post the breakup of the Soviet Union, we went into a kind of a unipolar world where the United States was the only global superpower. But now we've kind of moved into a place where we're in a multipolar world, that China is certainly a global superpower. Russia remains a very, very important power, a nuclear power. And we've seen instability, whether it comes to Ukraine or whether we are not sure what is going to happen in Taiwan. And my choice was that I became more concerned about smaller countries. So I felt far more comfortable investing in the larger superpowers, effectively, where you can kind of be very confident that there aren't going to be revolutions, say, or changes of borders. And for me, those include India, China, and Russia. Whereas smaller countries where I've had investments in the past, like the Philippines, I think I'm more reluctant to look at. I should say that India presents an interesting challenge for people like me, because on the one hand, I see and understand and am impressed by and excited by India's potential. At the same time, I'm not Indian, and I don't have an understanding of the subtleties of the Indian environment. So I'm far more restricted in the way I can invest in India than, say, the way I could invest in North America or Western Europe. I think that India is going to be is such an exciting place to be for the next 50 years. It's just great, actually. And the part of me that is Indian is off the charts excited. And you should know that when I visited India for the first time in around 2003, I actually talked to my wife about moving to Mumbai and spending a few years in Mumbai, which would have been an extraordinary adventure for our family. But many things took over; it didn't happen. But I think that it's interesting. So many things you set your bets or you set your investments, and then you watch them grow, and then the situation you're dealing with is not where you started off. And in my case, both China and India were a far smaller proportion of my portfolio, but because of the extraordinary performance of the companies that I invested in and their reflection in stock market values, they've become far larger, which is not a terrible thing.
Are you happy with your two India investments in Indian Energy Exchange and Care Ratings?
Yes. And so I both represent some, for me, very, very interesting ideas. Indian Energy Exchange is an example of what will make India such a great country over the next 50 years. I have, on one of my last trips to India, I started to really understand the impact of RERA, Real Estate Regulatory Act. I believe I've got the acronym right. And I think that what is so amazing about RERA is that India took on a regulatory scheme that doesn't come from Western Europe or North America. It's a regulatory scheme that I believe was developed in the United Arab Emirates, and it's extraordinarily effective in enabling capital to flow into the real estate sector in India. And so that's been an amazing transformation, even though I don't have an investment in the space. By the same token, India Energy Exchange, an example of Indian thinking, realizing that the right model for how to organize India's electricity markets, India needs to scour the world, find the best models, and bring them to India. In this case, when we move to renewable energy, those are far more intermittent sources of power, and every market participant needs to have an updated understanding of what the cost of power is. And the best way to do that is through an exchange. It's not easy because rather than trading wheat or corn, which sit in warehouses, you're actually trading a flow. You're trading a flow of electricity. But the markets have developed in that area, and India Energy Exchange is a very important participant in the Indian energy market. And through India Energy Exchange, it's institutions like IEX that is going to help India to develop the power that it needs to drive the Indian economy. India right now produces about 1/3 per capita of energy, say, in comparison to Western Europe or the United States. So that's got to triple as India gets to parity with Western Europe and the United States. And India Energy Exchange will play a very important part in that. To come to Care Ratings is for me a kind of an unusual investment. Care Ratings has had its ups and downs in that there have been incidents where Care Ratings has not given a appropriate rating to an Indian company. But I am extremely excited about the prospects for Care Ratings. Right now, all the major ratings agencies, including those in India other than Care Ratings, well, forgive me, the leading Indian ratings agencies, other than Care Ratings, are controlled by companies that have their headquarters in the United States. So if you take CRISIL, CRISIL's major shareholder, promoting shareholder is Standard and Poor's. And if you take ICRA, ICRA's promoting shareholder is Moody's, both highly respected companies, companies that in the case of Moody's, I have an investment in. And India is very lucky, and ICRA and CRISIL are very lucky to be able to draw on their knowledge and experience. But at the end, Care Ratings, which is not controlled by a foreign company, is local, I think is an extremely important participant in Indian credit markets. And the point that I've made, that I will make here as well, and I will make to any regulator that wants to hear me, is that it's extremely important for the future of India, I believe, that it has a local homegrown ratings agency that is not controlled out of Washington or New York or London. And to be slightly provocative, I think that it was an amazing moment in after World War II when India finally achieved its independence, and that was an enormous step forward. And I think that it's really important that India develop financial institutions that are independent. It would not be the vision and the fulfillment of the dream of an independent India is not completed if there aren't institutions in India which are independent of foreign control, if you like. So I am a proud shareholder of Care Ratings, but I would never ever want to control Care Ratings because I'm not Indian. And I think that Care Ratings has an enormous way to go. I'm extremely impressed with the CEO, who've had some interaction with. So there is a lot of improvement, low-hanging fruit that Care Ratings can make to reach parity with in quality and operational standards with the other ratings agencies. But it is imperative for Care to do that. Care needs to do that as an Indian ratings agency, not as some foreign controlled ratings agency, as a powerful competitor in India. And I would just tell you that I look forward to a future in which finance, global finance, is not dominated by North America or the Anglo-Saxons, by London and New York, in which global finance is not dominated by Beijing and Shanghai, but where Indian institutions have an important global role to play, in which countries, perhaps in Africa, and a bond issue in Africa or in Indonesia or in some part of the world that is not China, India, United States, can come to a ratings agency like Care Ratings and say, yes, we have Moody's and Standard and Poor's, but we don't want all of our ratings to effectively be controlled by decision makers in the United States. We also want one of our ratings agencies to be controlled out of Delhi. So it's, as you can see, I can talk at length about it. It's an exciting investment for me and unusual because I would like to say that Care Ratings is the market leader. In terms of quality, it's probably not the market leader, but we have so much improvement that we can get to, and I am excited about the people who work at Care who will bring it there.
Guy, I'd like to get your sense on the kind of regime we are in. Before COVID, interest rates were in a linear decline, cost of capital was low, and that led to birth of startups, fintech, consumer tech. Since capital was low, experimentation was very high. But in the coming decade, or in this decade, I think the reverse would happen. So if the world has taken a complete 180-degree turn, where do you think there would be value? What do you think will do well? Where are you on this debate of growth versus value?
You know, many market participants today, it's amazing to think about it, were not investors at the time of the 1999 NASDAQ boom. And a friend of mine, she had a job at one of these NASDAQ boom companies. It was a company called LivePerson. And and at the time there was something called vaporware, where companies would raise money to write some software, But rather than actually write the software, they would advertise that they were going to write the software. So a lot of the money that they raised went into advertising. And there was some amazing Super Bowl ads, for example, in the United States. And but the day that LivePerson, apparently there were employees who walked out of the office carrying various laptops and computers. I mean, it was kind of a crazy time. And in a certain sense, I think that this particular kind of what's happened in the last 18 months in the crypto world and in other parts of the tech world are nowhere near as dramatic, I think. I don't think as what happened in 1999. I think that also what's really important to understand is that we talk in terms of the evolution of species on the planet. There's a period called the Cambrian explosion. And when you look through the various layers of sedimentary rock to see what kind of species existed, you see this period of history where there was just a huge increase in the diversity of species that were around. And so the 1999 tech boom was a kind of a Cambrian explosion of companies. And we've had a kind of a Cambrian explosion of companies perhaps over the last decade since the financial crisis of 2009. But the fact that many of those companies may not survive in the form that they're currently in doesn't mean that it was a bad thing. Because what I saw from 1999 was that a lot of for example, engineers wrote software that then maybe wasn't successful. The company wasn't successful, but the software was useful, or there are bits and pieces of all sorts of things that are going to be very, very valuable for the development of the global economy. So I don't see this period as much of a bust as a period of restructuring. Now, if you happen to have only owned extremely highly valued assets with no earnings and some of them with no revenues, then you may have a lot of pain in your pocketbook. And I've seen companies whose valuations have come down 80, 90%. And that's extraordinarily painful for the individuals or for the funds involved. But for the economies in which those companies operate, I think it's still the fact that they exist or existed is an enormous positive because they will contribute to economic growth in other ways. So I see this more as a period of kind of consolidation. We have periods of Cambrian explosions and then of all sorts of things. And then we have periods of consolidation. I haven't been as skeptical as some market participants have, for example, on the crypto world, but I have absolutely no doubt that, they talk about that we're going through a crypto winter. There will be something that comes out of the other side of this. The crypto will always, I believe, it's not going to die a complete death. There will be NFTs on the other side of this. There will be cryptocurrencies on the other side of this. Certainly there'll be blockchain on the other side of this. And we have to go through a period of consolidation, and we shouldn't be upset about the period of Cambrian explosion, because that shows how our economy experiments with all sorts of different things and how capital can flow in all of these different areas. I think we should be proud of it. It's how humanity moves forward. And let's just remember that at the time of the automobile, there were hundreds of automobile companies, and all of those companies were experimenting in different ways and doing different things. And we came out with Daimler-Benz and Ford and Fiat and a few others, but there were way more before. The same about this period. I think that when it comes to individual investors and fund managers, what is extremely hard for us is that we have to be aware of that, but not lose our minds and fully commit to overvalued or highly valued speculative investments that may not work out. And some people are licking their wounds right now. And my word to them is, be kind to yourself. You were participating in something that was important for the global economy, even if it didn't benefit your pocketbook. Take the lessons learned, take the experiences learned, and find new opportunities.
Well, it's just been such an engaging conversation. Guy, I look forward to meet you very soon in person, whether it's in Mumbai or it's in Zurich. But here's wishing you best wishes for a wonderful 2023.
That's really kind. I wish you at ET the very, very best for 2023. And I want to tell every single person, it's primarily Indians who will hear this, I wish every single one of you a fantastic, not just 2023, but a fantastic next 50 years. India's star is bright and shining brighter. You, in a certain way, you won the ovarian lottery to be born in this time in India and not, say, 50 years ago in India. And thanks to the people like Nehru and Gandhi and others who brought India to this place. It's going to be a very exciting next 50 years for India. Forgive me for just running it off.
Okay, that's Guy Spier saying that, this is, of course, the best time to be an Indian equity market investor. Stocks he likes, IEX as well as Care.